Welcome back. Earlier, U.S. durable good orders for the month of August were reported to have declined 0.2% versus expectations of a decline of 0.4%. So it's a little bit better than expectations, although it does mark the second straight monthly decline. Again, durable goods are those products that are meant to last more than 3 years, such as computers, automobiles, and especially home appliances. And for that reason, it's very closely correlated to the housing market. When the housing market's doing well, uh, consumers will tend to buy new appliances like dishwashers, washing machines, and of course, when the housing market's not doing well, our consumption for those appliances decreases accordingly. Taking a look, we can see that the durable goods orders in this white chart has continued to trend to the upside over several months, although it is softening again, marking the second straight decline. And we can see here durable goods coming out at 272,659 level. It is closer to the highs. Again, it has enjoyed a nice steady trend to the upside, but it is now 2 months off of its recent highs, and that's coming out of the summertime, which is typically expected to be, a strong month for housing numbers, and of course durable goods as well. In another look, we can see durable goods here. Prior month was a decline of 0.1%. This month, 0.23% decline. Over the past 10 months or so, we've seen this waver in between positive and negative numbers, not really marking any strong case in either direction. But it certainly looks like it's starting to wane. Now, U.S. durable goods, if we take a look over here, the correlations that do exist with the housing numbers are very strong. Take a look at the correlation between the U.S. durable goods and the home price index. 94% correlation, which means that when the home price index goes up, the durable goods goes up. We could also see a 79% positive correlation between U.S. durable goods and the sales price for existing homes as well. So there's a very logical relationship between those two numbers. And over here we can see the blue histogram bars represent the durable goods. The red line represents a home price index. Again, a very strong correlation between those two economic barometers. Now, the reason why we mentioned the home price index in the housing market overall is we also want to take into consideration what's going on with interest rates they're on a never-ending climb to the upside. On the right, left-hand side over here, the blue line represents U.S. Treasury bonds, which continue to climb higher nearly every single day. And the red line represents the mortgage rates. Now, the difference between the mortgage rates, the red line, and the blue line, the 10-year bond, that's known as the mortgage spread, the relationship between these two. The mortgage spread is shown on the right-hand side chart in the yellow line. Now, typically in a strong housing market, we'll see this yellow line go up, meaning that the mortgage rates increase at a faster rate than the 10-year Treasury bond as a result of supply and demand in the housing market versus supply and demand in the bond markets. So we're seeing the mortgage rates continue to decline, and that is very closely correlated with the purple line, which is the S&P 500. So we can see over time as the stock market comes down, the mortgage spread comes down, and conversely, when one goes up, so does the other. As we see the S&P 500 flirt with new multi-year lows, we'll also see the same correlation exist within the mortgage spreads, and that's a little bit of a disturbing trend if we hope that the housing market will continue to go higher. Now, the blue line represents the housing index. The growth index is the green line. The green line, the growth index, is a combination of several different economic numbers that track the growth of the country, including retail sales, industrial production, capacity utilization, non-farm payrolls, business inventories, and also durable goods. So this green line, which has been hovering near the higher end of the chart, has now begun to retreat to the downside, following the red line, which is the inflation index, and now the blue line, which is the housing index. All three numbers over the past couple months have started to mark declines. Now, again, it's been subtle declines like the durable good orders, just a second straight monthly decline, only by 0.2%. But zooming out, taking a look at the big picture, I think it's important to recognize that all three of these barometers, growth, housing, and inflation, are all moving to the downside. With that said, as the Federal Reserve continues to promise higher interest rates, as long as we still see inflation hover near its recent highs, we also see the US dollar continue to trend higher. Now the US dollar has now gained the number one spot in terms of the RSI, the relative strength index, the US dollar. Now this is not the dollar versus the Swiss or the euro versus the dollar. This is just a pure US dollar relative strength. And that is the strongest currency of all the currencies we're watching here. Number 2 is the Thai baht, 3 is the Japanese yen. On the bottom end of the chart, the Hungarian font, the Turkish lira, as well as a Singapore currency, also near the lower ends. To construct a currency pair that we think is going to go higher or lower but maintain a very strong trend, what we want to do is take a very strong currency like the US dollar and match that against a very weak currency such as, well, the Singapore dollar. And you put the two of those together and you see here that is actually, that 100% tells us that is a 100% strongest trend of any two currencies in our basket or our universe that we're looking at over here. There's also a very strong trend between the Singapore dollar and the Thai baht. That's a 97%. 97% meaning it's 97% of a full potential trend based on all the different trends that we see over here. But by far, the US dollar is the strongest, Singapore dollar is the weakest, and that certainly is something very noteworthy. We can see over here the US dollar now has an RSI of 70. Now, RSIs above 70 can be considered overbought, but it doesn't mean the market has to stop when the RSI hits 70. It could go to 80, it could go a lot higher than that. So 70 only tells us that the US dollar continues to strengthen, and we can see going back to September 19th, the US dollar had an RSI of 58. September 20th, 59, 62, 63, and now we're at 70. So this trend is here, and it's been here for a while, and it looks like it's continuing to strengthen over time. Taking a look at the right-hand side chart, we see the total bond yields. That's as if we were to add up all the different yields of all the different maturity bonds. That red line continues to trend higher. Very strong opposite correlation to the S&P 500. That's the blue line. As the bond yields go up in anticipation of higher interest rates, stocks go down in anticipation of the same, higher interest rates. It's a very clear dynamic what's happening here. And until we see solid, concrete economic numbers that prove otherwise, we have to assume the Federal Reserve is going to continue to raise interest rates until inflation comes down to their targets. Now, very interesting over here, we can take a look at the bond meter. Now, the yellow background area chart, that's the S&P 500. That continues to trend lower and lower. The green line represents the combination of the spreads of the short-term bonds. So if you take the 1-year, 2-year bond spread, you add that together, then the 2 to the 3, the 3 to the 5, etc. Those short-term bonds tend to perform very well, at least as of late, when stocks go down. As you can see back in June, as the S&P 500 went down a lot, that green line went up a lot. Now the blue line represents the culmination of the long-term bond spreads, the 30-20 spread, and then the 20-year, 10-year spread. Add those together. That's the blue line. The red line represents the medium-term bonds, the 7 to 5, the 5 to 3, etc. And what we've seen very recently, just in the past day or so, is a crossover. The medium-term bond spreads, that line has crossed above the long-term bond spreads, and it really is just following and continuing to show what the green line has already demonstrated to us, that yields are moving, or the capital is moving out of short-term bonds. When traders sell bonds, the yield goes up. So they've sold a ton of these short-term bonds. Now it looks like, relatively speaking, they're selling more of the medium-term bonds and plowing all the money into the long-term bonds. And that's just, again, a continuation of what we've seen. For the longest period of time, we just saw all the capital move out of the short-term bonds. They're selling the 1 year and the 2 year, and that's why those yields are so high. Now the traders, it looks like they're starting to sell the medium-term bonds. And eventually, I think that the lowest yield you're going to find is the 30-year, the 20-year bond, which is really opposite of what you would expect to see in a normal market condition. In a normal market condition, you would expect to see the highest interest rates in the longest maturities. But that's kind of the opposite of what we're seeing here. Now, also, I wanted to take a quick look at a very interesting dynamic, what we're seeing over here. Now, every one of these histogram bars on the left-hand side of the chart represents the S&P 500 in terms of their own respective industry or sector and their relative strength. The right-hand side shows their own 52-week range. So first of all, on the left-hand side, the sector that represents the strongest relative strength is the 10-year Treasury Index. No surprise there, since those 10-year Treasury bonds are outperforming, by far the shorter term bonds, and those yields are, continue to go higher and higher over time. The number 2 is a volatility index, the VIX, the fear index, which tends to go up when stocks go down. Now, those two have an RSI above 60. After that, the rest of the market overall, the rest of the U.S. economy, as depicted by these S&P 500 ETFs, the sector ETFs, they all have an RSI below 50. Well, except for number 3, that's the Gemini Bitcoin index. So if you take away the bonds, the VIX, the volatility index, and the Bitcoin index, those are the only 3 indices that have a relative strength above 50. All other indices are trending lower. They're below 50. Although for the most part, they're all pretty much evenly matched. Take a look at the right-hand side of the chart, though. This shows those same S&P 500 indices, but this time in terms of their own 52-week range. Now, the 10-year bond, 10-year Treasury index on the left-hand side, that is at the 90% level. 90% of its 52-week range. So again, if you imagine a stock that has a range of $0 to $100 a share, this would be trading right around 90, right near the highs. Number 2, volatility index. Number 3, and that's at 50%, is the energy index. So the only 2 indices that are trading closer to their highs than their lows are the 10-year bond indexes and the volatility index. But more interesting than that, notice the gold and silver index on down. All of these are hovering below 10%. These are within all of these indices, which represent by far the vast majority of the S&P 500, are trading within 10% of their 52-week lows. Again, if you imagine a stock $0 to $100 a share, most of the S&P 500 is trading within $1 to $10 a share. And that is pretty shocking. We want to see in a healthy market, we want to see the capital spread out more or less equally among different industries, energy and retail, and all the different components that make up our economy. But it looks like if you exclude bonds, volatility, cryptocurrencies, oil sector indices, a couple of healthcare, but that's even not so strong. Yeah, if we really exclude out the Treasury bond and the volatility index, the rest of the S&P 500 is much, much closer to the low. Now, I think it's important to recognize the difference between the two. The left-hand chart is a relative strength. That is more reactive to current market conditions. So it looks like they're trending lower, but not to a huge extent. But that's just as of late. But if you take a look at the bigger picture in terms of their own 52-week ranges, and this, I think, more accurately describes or portrays our own, investments, 401k plans, etc., it shows us that most of the stocks in those plans are much, much closer to the lows than their highs. So certainly the trend is your friend. The trend is to the downside in stocks, to the upside in the dollar, to the upside in bond yields. And now we see durable goods have begun to wane, and housing market numbers have not been that hot lately. So we should be very cautious as far as trying to step in and pick a bottom. The relative strength index, if we saw numbers below 30, 20, 10, etc., I think that would be a lot more compelling for us to want to, get involved in a trade. But that's not technically oversold yet. So we want to wait for some sort of capitulation moment if we're looking to, pick a bottom here. I personally don't think we're there yet. But, certainly only the future will tell for sure. We hope this has been helpful. We look forward to seeing you back soon.